everyone, John Henry here, slingshotfutures.com, and welcome to the Market Mindset, where we take a look at the psychology behind the moves today so we can better understand it tomorrow. And today, we're taking a look at gold. Now, gold, for the most part, has had a very nice bear trend working its way down for really the entire day. I mean, it started right around midnight or so and hasn't stopped. Really nice bearishness on the way down now. Unfortunately for us, in this case, we don't open the room until around 8 o'clock, so there's not really a way to participate in any of this. But when we come in, right off the bat, we see a quick little snap back towards the moving average. Now, by itself, that's not necessarily good enough. But we have a quick blow off on the bottom, and that's looking a little bit weak. And when they try to come back down again, they end up trapping the lows, right? They trap the lows by one tick and pop back higher. But if this is going to be a trap and it's going to be a reversal, where are the buyers, right? Notice the weakness from the buyers. Really strong bull bar, good bull bar, doji. Bad bull bar, terrible follow through into the moving average. Where are the sellers, or where are the buyers rather, if they're going to take this back up to, even if they have a hope of converting this into a range, where are they? Why can't they show up to the party? So that's one of the big questions that you got to ask yourself when you're in this type of location. Where are the buyers? They trap the low. They have everything in the world lining up for them to try to go higher, and they fail. We get a big old doji, an inside bull bar, and a complete trap right off the moving average. They can't even get above it on a nice downtrend. Really tough to ignore that one. So a beautiful bear bar and a gorgeous sell signal right after the open to drive the market down with continuation. So a nice quick right off the bat sell side move. Now we continue back down to the lows, and we start looking at this thinking, well, we may be stuck in a little bit of a, maybe they're going to try to challenge the double bottom. They trap underneath the lows. Could be. The sellers obviously are running out of steam. They're nowhere near as aggressive back here as they were back there. They're getting traps on the lows, but now we're starting to pick up speed again. They're breaking down. We have to wait to see what they want to do. We get a little bit of a lift back towards the moving average. And again, we see signs of exhaustion. The buyers are trying too hard, too fast, and they end up getting stuck. We have a small bull bar, a bigger bull bar, a bigger bull bar. You can see them kind of ramping up on the gas pedal. And when that gigantic bull candle forms, they get a doji into a bear engulfing candle. Something is wrong again. Where are the buyers? They can't follow through with their movement. So that offers up another selling opportunity to drive the market back down to the lows. Now, in this case, this is where things start to shift a little bit. The sellers fail to get down to the lows. They miss a new low, right? They get down to the low closes. They miss that by a tick. But overall, the sellers aren't showing up to the party anymore. Now, we do have a prevailing long-term bear trend. It's hard to argue with the overall trend. So that tells us that the sellers probably aren't done. They're just looking for better prices. We see the sellers driving down, failing. They try again, really nice bear bar, but in the context, it doesn't make any sense to try to go for it anymore because they've already failed, and it ends up being a bull trap. The buyers don't follow through, but then we lead into a secondary attempt from the sellers. And if the sellers are going to take it lower, this is usually where they do it. They have that first attempt down, they pause and make a second attempt down, trapping in the buyers and using a stop run to slam the market lower. They get everything lined up, beautiful bear bar, they enter in, and it immediately reverses against them. That is a big red flag. Even though we are in a bear trend, that could deem a long trade, albeit aggressive, to jump in and try to take that back up to the upside, knowing that sellers aren't content yet. If the sellers were content with the prices they've gotten, that would have rocketed down to the downside and just collapsed. It didn't. And that's the big key, because that failure means that now we have sellers who entered here, we have sellers who entered here, and their stops are going to be above here and above here. So likely, if sellers are looking for better prices, they're going to be looking for where those stops are, right? They want to whip out the sellers, earlier sellers, the aggressive sellers, because we're not in an aggressive market anymore. Use their stops to their advantage, get the buyers involved a little bit to push the market higher, and now the buyers, earlier sellers, and new sellers are all selling at the same place. They're getting out to force the market back lower. So all of the sellers that had buy stops above these previous highs, well, guess what? They fueled that little spike up. And that leads to a nice buying opportunity to push the market up into those highs. But that's it. Remember, the long-term trend is bearish. You're not looking to hang around to see if this goes another 1,000 ticks, because it's probably not going to. What we're looking for instead is for a potential reversal. We are being given, or at least the sellers are being given, an area of big interest and better prices. We have the sellers who turned into buyers, maybe unwillingly, as they got stopped out, and that caused that big breakout to the upside. But notice, no follow through again. So even though there was a huge amount of buyers there with the sellers getting whipped out, none of them hung around. It didn't continue. And that's a big clue that sellers were absorbing those buys into an attempted accumulation to push back down to the lows again. And that offers up another follow-up, nice little selling opportunity to drive the market back down. And that may even be offering up another one right here, depending on how it forms. Now, it went bullish. So in that case, it's a great example of kind of using the context of the market. We have a beautiful bear trend. We bounce off the moving average, first trade of the day, easy peasy, to the downside, slam the market lower. We come back up, we give it another shot. It can't make it to the low, and it starts reversing. Okay, finger off the gas pedal a little bit, give it a second, right? See what happens. The sellers try coming in, they get trapped. Sellers try coming in again, they get trapped. Goes the opposite direction. Nice long attempt for a possible scalp to the upside. But when we start hitting good pricing for the sellers, they start diving back in, and that offers up another selling opportunity to drive the market down. So constantly paying attention to the context of the market, what's happening, and does it make sense for one side or the other to kind of be dominating price, is really all it took today for gold to find some potentially pretty good opportunities to trade. So that's going to do it for this one. Hopefully you learned something. Hopefully you found it interesting, a little bit useful and entertaining as well. And we'll see y'all next time.